Traditionally, the go-to way to grow a real estate portfolio quickly is to take on renovations. You put in extra time, effort, and risk to upgrade a home, and because of this, you can substantially bump up your property's value within just a few months. The benefit of this is not just that you can get better returns, but also because you can front load your rate of growth. Instead of just getting 4% in appreciation every year, you can get a quicker 20% bump in appreciation within just months. So this means your capital will grow quicker in the beginning so that you can reinvest it sooner and longer, so you get better total returns compared to having those returns spread over a longer period of time. Then, since COVID started, there has been less of a focus on value add opportunities because there were just easier opportunities elsewhere. Investors got access to ultra cheap debt, crazy high 40 to 50% market appreciation in just under 2 years, and so putting in sweat equity just wasn't worth the time, added risk, and extra money during the past 2 years. Now, things are changing yet again. Honestly, I feel like we're just going back to the more normal situation with lower appreciation and higher interest rates. But because of this, investors are leaning towards more value add opportunities, so now properties that need work are making a comeback. If you're new to real estate investing and you want to get into value add opportunities with a limited budget, the more confusing thing might be to figure out what makes the best use of your renovation dollars because returns might not be the same everywhere. It's true, some renovations cost more, are higher risk, take longer, and yet do not give you much value add appreciation. So in this video, let's talk about what types of renovations you should be focusing on and how the types of renovations you choose might change depending on your budget. Before I begin, don't forget to give this video a thumbs up and subscribe to our channel so you see more videos like this made specifically for real estate investors in Toronto. There's actually two parts to the value add equation. And the first part comes from the fact that you're getting a bump in returns because you're putting in sweat equity to upgrade the property. Most end users and some investors don't want to deal with the time and added risk of renovations and are willing to pay a bit more for something that's ready to go. So what you see is that the buyer pool shrinks for properties that need work, and so you can get a bit more of a discount if you take on these projects yourself. But like I mentioned, not all renovations are worth the same. In my opinion, I'd say there's 3 broad types of renovations. The first is my favorite and easiest, cosmetic renovations. Picture your grandma's home, which she's lived in for the past 60 years. It's old, but it's still extremely well maintained. But because she's lived in it for the past 60 years, everything inside looks like it is 60 years old. And so if you buy a home like this, you would have to modernize it and make it appealing to today's audience. This is the most straightforward renovation you can get. Not much can go wrong when you're replacing kitchen cabinets, bathrooms, floors, and painting the walls. And because of this, projects like this don't take that long to do and generally don't require permits, which can reduce your renovation time. On the other hand, the end results are huge. There's a big wow factor when it comes to cosmetic renovations, and so they can generate the best ROI. I took a look at the numbers from HomeStars and the Appraisal Institute of Canada, and here's what I found. The ROI of a kitchen makeover is between 75% to 100%. A bathroom makeover is between 70 to 100%, and a new paint job can generate between 50 to 100% in ROI. We have cosmetic repairs, and then we have structural repairs. With older homes, you'll find that some things are typically not up to code. For example, you might find knob and tube electrical wiring throughout the house, and so you'll need to replace the whole thing to bring it back up to code. If there's an old oil tank in the house, you'll need to get rid of it. You might even need to replace an old furnace or a worn-out roof. The thing with structural repairs is there's not much of a wow factor. These things are generally expected to be there and working, and so these repairs are definitely needed to maintain a home's value, but you generally won't find much value add returns from taking on these projects. The other thing is that some structural repairs like plumbing or foundation issues might be much more risky compared to cosmetic repairs just because you don't know what exactly you're in for until you rip apart the walls. So higher risk, less value add, and possibly more time and money do not make structural repairs very attractive if you have a low budget and you're looking for the best returns for your effort. The third type of renovation is what I call creation projects. What this does is it creates more valuable rentable space within your existing home, and so you can substantially improve rent yields. For example, splitting a home into 2 units can raise your monthly rent from $3,200 as one unit to a combined total rent of $4,000 with $2,600 on the upper and $1,400 on the lower. It's even possible to take that one step further if you're able to add in extra bedrooms, which can raise your rents even more. For example, if you turn a 1-bedroom basement apartment into 2 bedrooms, then you might get an extra $400 bump in rents down there as well. Absolute returns are great for creation projects, but they do require more work, money, time, and risk compared to cosmetic renovations. So the ROI is good, but it's actually not as good compared to cosmetic repairs. HomeStars tells us a new basement suite might generate around 70% in ROI, and AI Canada expects around 50 to 75% in ROI. As you can see, if you have a limited budget and you have to choose between these 3 types of renovations, you can get the best bang for your buck if you go with cosmetic repairs. Once you've exhausted all possible cosmetic repairs and you still have extra budget, move on to creation projects. And then, if you have extra money, we can start talking about structural repairs. I know what's going through your mind right now. If structural repairs don't have much of an ROI, why should you even take them on? Okay, here's the other part of the value add equation. Besides getting a bump in returns when you trade in time for money, you can also get an extra bump in returns if others get priced out of more major expensive projects. When we talk to real estate investors, most of them will have no financial issues with taking on cosmetic renovations under $50,000. But when a house needs more work involving all 3 of the renovations I just talked about, cosmetic repairs, structural repairs, and creation projects, then we're looking at a much bigger budget. This means even if an investor was willing to take on these projects, they might not actually be able to afford them from a budget standpoint. So when this happens, more buyers will end up dropping out of the buyer pool, which means buyers who can afford these more major projects are able to get an extra discount. If you take on a $40,000 cosmetic repair project, you might get an ROI of 75% or a return of $30,000, which is awesome. If you take on a $40,000 creation project, you might get 50% in ROI or a return of $20,000, which is a good second alternative. If you do a $20,000 structural repair, there is not much ROI on its own. But if you choose a project that needs all 3 of these things, you'll first need a bigger renovation budget of $100,000. And if you do this and you're willing to take on these bigger projects, you might get a further 5% discount off of the purchase price. On a $1 million home, that's a $50,000 bonus. So now your returns look much better at $100,000. In other words, you bump up your renovation ROI to 100%, which is better than any of the 3 renovations on its own. Let's test things out and see how numbers might change if you take on an even bigger project at $150,000. Remember, it's not just $150,000 that you're forking out, but you also have to pay around $250,000 for the down payment, closing costs, and holding costs on a $1 million home. So this means you'll need around $400,000 of capital for a project of this size. If you're able to get an 8% discount off of the purchase price because of the size and scale of the renovation project, then you'll make an extra $75,000 compared to taking on smaller projects. So in this case, your absolute returns are better at $150,000, and your renovation ROI starts leveling off at around 100%. But take a look at this. That extra discount for taking on bigger projects is actually taken off of your purchase price. So if you do a $150,000 renovation project on a more expensive property, then you can get an even bigger discount if you get 8% off. So in this case, your absolute returns gets bumped up to $187,000, or the best ROI of 125% in this case. As you can see, your renovation ROI doesn't only depend on the type of renovation you choose, but also on your total project size. If you have a more limited budget and you have to pick and choose your renovations, then choose the ones with the best ROI, which tends to be cosmetic repairs. But if you're looking to generate the maximum ROI and you do have a bigger budget, then there is a sweet spot where you can get an even better ROI on more major renovation projects up to a certain point because of the extra discount for bigger projects. But just note that as the project gets bigger and bigger, the dollar amount of the returns do grow, but the percentage discounts start tapering off. And then once you hit more massive renovation projects beyond, say, $200,000, you're likely going to move into more of a development space, which is a different class of work compared to our typical value add renovations. You're going to be looking at a more extensive permitting process, a much longer project duration, and you'll likely have to deal with construction loans as well. The second thing I wanted to talk about is to make sure that the property you buy, even if it's distressed, is still livable. If it's not livable, you're not going to qualify for a bank mortgage, which will make the whole deal fall apart. If you end up going with a private lender for this, the substantially higher interest rates will negate the budget discounts from bigger projects, so it probably won't make sense either. The third thing I wanted to touch on is that even though your value add returns are a one-time bump, that doesn't mean you'll get better returns if you sell your upgraded project after a short period of time, because transaction fees over a short period of time will eat into your gains. For example, if you end up making $100,000 from a $100,000 reno, but you end up selling the property after 5 years, the extra transaction fees that you incur will be around $87,000, assuming property prices go up 5% per year and you pay 5% in transaction fees plus HST. In other words, you'll only make $13,000 more versus doing nothing on a turnkey property, which in my opinion isn't really worth it. I actually think the biggest main benefit of doing value add work is that you accumulate wealth much more quickly in the beginning, so this will let you scale and invest more money sooner, and so you'll be able to get much better total returns in the long run. Remember, renovations actually lower your leverage if you're paying for them out of pocket. So if you're looking to maximize your returns, you'll need to refinance your property after renovations so that you can get the same amount of leverage compared to a turnkey investment property. Once you pull out that money, you'll want to reinvest it into something with similar returns to maximize your ROI. Next, renovation success and returns will depend on your experience. If you're very experienced in renovations, then you'll likely make fewer mistakes and finish a project in less time compared to a newbie. In other words, an experienced investor might have a very different ROI compared to someone who's still learning the ropes. So even though it can be tempting to choose bigger projects once you see the more attractive returns right away, we always recommend starting with easier and smaller projects first. There's a lot to learn already with real estate investing, and taking on a very complicated project might actually stall your growth if you go over time or over budget. Assuming you're going to continue to refinance and grow your real estate portfolio, your first project will likely not be your last. Keep things simple, start small, gain that experience and confidence so that you can achieve long-term success. Of course, getting help from experts who know what they're doing can also help you speed up this learning process. We're not your regular real estate brokerage, but we're also real estate investors, and we purposely tackle the most complicated projects so that we can help you better and you can learn from our mistakes. And when we help our clients with real estate investing, we take an end-to-end approach. We start off by learning more about your needs and requirements, teaching you what makes a good real estate deal, and then help you buy your investment property. As an exclusive service for you, if you're a client, we guide you through renovations, like what renovations are needed, how much things might cost, show you what your returns might look like, and then connect you with our reliable network of contractors. Once your property is ready to go, we also have optional leasing and property management services if you need it. So if you want to learn more about how we can help, just connect with us by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.